Hi, I'm Jeff Bermet. I'm one of the co-managers of the Libero Dynamic Solutions and Cautious Portfolios. June was a strong month for equities as Trump sort of backed down a little bit on his high tariff rhetoric. In fact, the term taco trade continues to float through the markets. Trump always chickens out. He threatens very significant tariffs and then walks those back to much more modest levels. So June was a month characterized by calmness on the tariff rhetoric, and so the equity markets responded very positively to that, the US markets leading the way. We also had a brief geopolitical flurry when both Israel and the US bombed Iran to eliminate their nuclear capabilities. It's not conclusive exactly if that's been totally eliminated, but Iran showed a very feeble response and markets quickly forgot about what happened there. We had 3 central bank meetings last month as well. The ECB was first and they cut rates again down to 2%, as inflation is down to 2% in the Eurozone. So they are at their target and feel that they had room to cut rates one more time. They did sort of suggest this might be the last cut, barring new developments in the markets. And they also hinted at they're watching very closely what's going on with tariffs and what impact that will have on European growth, as the Eurozone is a large exporter to the US. The Fed met as well. They also left policy on hold, and they were very explicit about saying they felt there were significant inflation risks from tariffs. They were expecting inflation to rise in the months ahead because of tariffs. They just don't know how much because they don't know at what level tariffs will settle. And then the Bank of England also met and left policy on hold and cited similar concerns about what tariffs were doing to world markets, but they also specifically talked about the continued strong wage pressure in the UK, and inflation did in fact back up above 3% now for 2 months in a row here in the UK, so they feel going slow is the best process as far as rate cuts are concerned. The US finally passed its one big, beautiful bill. This was the tax cut that Trump had promised everyone, and it expands the US deficit by another 3-some-odd trillion over the next 10 years. In the UK, you had an attempt by the Labour government to reduce some of their welfare spending. That failed, and in fact, it looks like net welfare spending is going to go up rather than go down. The bond market in the UK didn't like that. The foreign exchange markets didn't like that. This is just symptomatic of why we are nervous about longer duration fixed income in the portfolios and continue to stay away from that, as there is just no fiscal discipline anywhere in the developed world. And it looks like it's going to be up to markets to force governments to restrain spending, and even though there were negative market reactions, they weren't large enough to really dissuade the governments from what they're doing. So I fear that going forward, we are once again hostage to Trump's tariff negotiations. Tomorrow, July 9th, is supposed to be the deadline for trade deals, but it looks like that's been pushed out to August 1. So there again, the taco trade may be happening right in front of our eyes. Trump did say Japan and South Korea would face 25% tariffs on their exports to the US. You know, both Japan and South Korea manufacture automobiles in the US already. So it is not clear what Trump wants them to do in order to have those tariffs reduced. There are already 25% tariffs on a lot of automobiles coming into the US. We've seen US consumers sharply cut back in May and June in their purchase of automobiles. So it is likely that we may see similar responses by consumers to other tariff increases on imports into the US. So again, we are hostage to how this develops. It looks like we've got another month now of negotiations. I will let the co-manager, Nick Davis, talk to you about sort of the highs and lows in the portfolio and where we made money and what we're hoping happens in the months ahead.
Hello, I'm Nick Davis, one of the co-managers of the Libero Dynamic Solutions and Cautious Portfolios. It's been an interesting month where we've had the prospect of potentially a third world war breaking out with the actions of Israel and Iran, and the will they won't they of Mr. Trump, and the surprise actions of the US intervention. The world has moved on, and that's ignored that as it seems to have come into a period of relative calm. But during that period, also, we saw oil prices move and react quite dramatically to that. And that's been helpful to us in the portfolio with our positions in oil stocks, which we've been holding for cash flow, and in particular BP, with the expectation some level of corporate action, i.e. a takeover of BP at some point. The valuation still looking extremely attractive to its peers globally. One of the areas where also you'd expect potentially to have seen quite a strong reaction was in the defence stocks. This month, these stocks, which have been fantastic for us so far this year, had a very kind of muted month as we had the NATO big summit, and the expectation here was for a level of spending to be agreed amongst NATO members. That was agreed at 5%, and a number of very strong orders have come out since then for people like Rheinmetall, one of the stocks we hold in the portfolios. This is really helpful to us, despite having a weak month after a fantastic period so far this year. These orders come through, reinforce the long-term nature of the growth in these businesses and the long-term cash flows we expect to see them produce, and eventually, hopefully, even some dividend income from these companies. One of the areas that has been particularly strong over the last month was the tech sector. I've been fairly muted over the time with concerns about AI expenditure and is there actually any sort of real generation from this. Meta had a really strong month for us, as did Microsoft, and also the chip stocks. TSMC, which again comes under concerns about potential issues around China invading Taiwan, again had a very strong month. So these stocks have actually been very helpful to us, and again that consistent long-term theme that we have towards technology has been really positive for the portfolio. Financial stocks have been very strong for us as well, and holding in Commerzbank has been particularly good for us in the portfolios, and also the discussions around a potential bid from UniCredit of Italy, which how we see the new enlightened period of cooperation amongst European nations inside the EU, the prospect of an Italian bank taking over a German bank, perhaps inconceivable even 10-15 years ago, is now on the horizon. Again, this is one of the rationales for us buying into this sector, along with the prospect, as Jeff mentioned, of very positive economic scenario in the background for the EU with inflation coming down. As Jeff mentioned, we've had a slight, very mini Liz Truss moment with the government reneging on its decisions to cut back on welfare spending, and a mini wobble in the bond markets, which seems to have recovered as they've sort of expressed confidence and strength in Rachel Reeves as the ongoing Chancellor of the Exchequer. Federal Reserve Chairman Mr. Jerome Powell has come under extreme pressure from Mr. Trump, being a numbskull, an idiot, and I think even a moron at some point he was described as. These are concerning, as Jeff mentioned. Again, this indicates issues around credibility for the US as a dollar country and a dollar reserve for other nations to hold this currency. Again, Mr. Trump is pushing for short-term interest rates to come lower, but with the Big Beautiful Bill, we expect to see the deficit increase by at least another $5 trillion. As we've mentioned previously, the concerns about deficits is not just reserved to Europe and the UK, but again the US. And the impact, again, we see here is while the President can push for short-term rates to move down to 1%, we would expect markets to see this and would expect longer-term yields to push higher as a reflection of this about concerns about the level of deficit and the levels of inflation. And again, this is one of the concerns, as Jeff has mentioned, with the tariffs as they come in 20-25%. These will be reflected in prices that US consumers will pay. Effectively, this will be inflationary. And we have these concerns, which is why we still remain relatively lowly allocated to dollar assets and have concerns about holding dollars full stop within the portfolios.